You know, to start off with a smile. It's Real Estate Tuesday, people. Move the camera a little bit. Happy, tantalizing, terrific Tuesday. Hope you had a great starting day. It's a great day to have a great day. That's what I always tell my students. So let's get into it, right? Um, it's a lot of going on in our economic climate at the moment. And, I always like to dive in because I'm a real estate professional. My name is Toria Howard, by the way. I'm an educator, but I'm a real estate professional and financial literacy educator. I do business funding as well. So, all around wraparound services for you, for your real estate needs, your financial needs, and your business. So, I always want to come on Tuesdays to talk strictly about real estate and how it relates to finances. So drop a one in the comments if you're watching this live, drop a two in the comments if you're new to my live, and drop a three if you're watching the replay. And I really appreciate it. So a lot of times, people are misinformed about a lot of things when it comes to real estate. So before I start my 10-minute timer, I wanted to discuss what's going on with the mortgage loans right now because the busy selling season is coming up. People are, buying homes right now. It's getting warmer. More people are going to be putting their homes to the market. So I want you to know and be aware of where our interest rates are at the moment. And it is based on your credit score. So it will vary. So right now, if you have a 740 to a 850, your 30-year fixed rate is 7.6. Okay. Now, that might seem high to some people, but you have to factor in, how much you're spending on rent. And, that is going towards something that's actually yours. Okay. And versus you paying somebody else's mortgage. And I know a lot of people are up in arms about, oh, what about the maintenance costs and things of that nature? That's what's called the budget. You budget for those things. So you have your roof, your HVAC, your electrical, your plumbing, your foundation. Am I missing something? Those are the five major things, right? Roof, HVAC, plumbing, electrical, foundation, right? Those things you can factor into your budget and save incrementally throughout, every month. So if you know that your roof is going to last 15 to 20 years, you take the cost of your roof divided by the 20 and then divide that by 12, and you'll know how much you need to save every month for your roof. Same thing with your HVAC. Find out the cost of what a replacement of your HVAC, whatever brand that if you like high end or low end or whatever, find out how much that costs, how long they usually last, divide that number by how much it costs, then divide it by 12. You'll know how much you need to save every month for the HVAC. But you do have home warranties and you do have homeowners insurance. So some of those things are covered under those insurances. So you just have to know and understand how that works because a lot of people are misinformed about, oh, well, what about the maintenance and this and that? You can budget for that, but there's also insurance that will help you be able to recoup those losses. Now, your roof, that's something that you will have to replace over time. But if something damaged your roof, like weather related or some type of freak accident or something, then your insurance should cover it. But you need to make sure that you understand your coverages. Home warranty protects like the stuff that's on the inside, right? Your appliances, I wouldn't say stuff on the inside, but your everyday use stuff like your HVAC, your refrigerator, your washer and dryer, if you have some type of a plumbing issue, though that type of thing. Now, your home owner's insurance protects the dwelling. So, if it's a case of a fire, or water damage, weather related, those things are covered under that. But you need to know your insurances, and you also need to know where do you live geographically, and what other coverages you need. Flood insurance, like in Memphis, it's a flood zone, so you need flood insurance. And and earthquake insurance. Usually it's a rider. The flood insurance is separate, and usually it's the earthquake insurance is a rider on your insurance. In certain areas here in Detroit, you have certain areas that flood, so you need to make sure that you have coverage for that. Basements flood and things of that. And make sure that's covered because and make sure that you do the things that you need to do to maintain it, right? So I just wanted to come and say, yeah, like right now, the mortgage rates are 7.6% if you have a 740 to an 850. Now, if you have a 720, why is it going away? If you have a 720, it goes up from there, 720 to, I'm looking for my chart I just had. But anyway, I just wanted to go in there. So your interest rate does matter. So those of you that are not homeowners and looking to become one in the next 6 months, or I should say, I'm gonna start with 3 months. Some people are ready, right? So let me start my timer now. So I got 10 minutes to discuss this. I just wanted to give you that tidbit. So if you know that you're about 3 months out of buying a new home or whatever the case may be, one thing that you need to do first is assess your financial health. So at this point, if you're 3 months out, that means that you need to do small little things here and there to improve your credit. So you already, your finances, or however that looks. So you already have probably a pretty good credit score. You might want to get it up some. You might have some savings already. You might want to increase that a little bit. So these are for people who are like ready, without a lot of high, I would say high, um, things that are, that are going to prevent you from becoming a homeowner. I should say that. So you take a deep dive and look into your finance. You calculate your monthly expenses and your savings. You understand your financial standing, and that will help you determine how much you can afford and spend on a home. So if you're paying a certain amount of rent right now, and that's comfortable for you, say if you're paying 1,500, and 1,500 is comfortable for you, and you have disposable income, and you're not living paycheck to paycheck, or you're not living beyond your means, then that that's something that you can afford comfortably. You want to be able to understand your finances and know what you want to afford comfortably. $1,500 is where you want to be. Then $1,500 it is. 2,000, 3,000. Those of you that are balling, 5,000. Listen, if you can afford it comfortably without having to struggle, then that's what that's what looking at your finances look like. So at this point, if you're 3 months out, you might want to boost your credit score. Hey, Tony, you might want to boost your credit score. So you might have something that you might have to get removed, or you might need to pay down some debt. Um, so there's just different things. If you're 3 months out, some small incremental things that you need to do. Usually if you're 3 months out of being able to purchase a home, you probably don't have much negative items on your credit report. You probably just have, where you have high balances, and you want to, decrease those balances, because you want your debt to income ratio, to your DTI, to be as low as possible. So you want your debt to be lower than your income. That's the point. So if you have a 740 to a 800 credit score up, you can have a higher debt to income ratio, but you don't want, unless it's good debt. Now, it's a difference between good debt and bad debt. Good debt is something that's making money. You're making money off the debt. Bad debt is that you're just paying, you're not getting any reward. So I was just explaining like that. So it's a difference the way that the underwriters look at it. So if you have good debt, good high debt, and you're making revenue off of it, that's not a problem. But if you have a lot of debt that you're just paying and you're not getting any money off of it, then that's kind of frowned upon. So you want to try a method of either a snowball effect, where you start with the smaller debt and then roll it up to the bigger debt. Or if you want to be more aggressive, start with the largest one and roll it down. So that's up to you. And then start saving for your down payment and closing costs. Now, first time home buyers, you do have incentives, right? In your county, in your state, or whatever, federally, you have first time home buyer incentives. Now, it's based on your geographical area, the population, your income, all of those different things factor. So you need to make sure that in an interim that you have like a 3% down payment, 5% at a maximum. But depending on what your qualifications are, you might not even need it. But it's better to have it and don't need it than to need it and don't have it. So that's the whole point. You want to make sure that you have this, because you can get a home loan 3%. You don't need 20%. Unless you're getting a jumbo loan, and even those are like at 10% at some places. So it just all depends. The jumbo loans are, depending on your geographical area, are loans that are $500, $600, $700,000 or more. That's what, and that depends on your population and your geographical area. Of course, if you're in high dollar areas like New York and California and some places like that, the limits are going to be a little bit higher. And then FHA has increased the limit. It used to be low, like 3 to 500,000 or something like that. I'm not saying that's low, but I'm just saying the limits used to be low depending on your geographical area. So in some areas, like a FHA loan, you could get 3%, only on 300,000. Now it's up to like 750. So you can still get 3% down with a $700,000 house. So, but like I said, first time home buyers have incentives. So check your local, your local lenders. Make sure that you are having those conversations with them to see what you qualify for. So now let's get to the people who are a little bit, a little bit more further out. What about the people that's 6 months out, right? So, because when you're 3 months out, you already know the neighborhood, the type of property you want. You probably already have that part down. You just need to just hone in on your finances. Now, if you're 6 months out, you want to look at research the neighborhoods and property types. If you have children, you want to know what the school district is. If you like walkability, if that's a walkable neighborhood, if you like living close to downtown, or you want to live in the suburbs, or proximity to work. And you want to make sure that your home is valued at a point where you're coming into it with equity, possibly. So a lot of, new construction, equity. So it all depends. Equity is not, depending on how long it's been sitting. Equity is not automatically built in when you're talking about new construction. So it's best to find a home in a great neighborhood. It's the ugliest house on the block. You might have to fix it up or something if you want to go in, because you have to think about buying a home as a first-time home buyer, regardless if it's your resident, as a investor. So investors, buy low and sell high. Okay. And you want to come into that where your first home, you want it to be an investment that pays you. You want the equity to be up top. So it's good to, maybe find a fixer up, and you have, loans that'll help you be able to do that. So next step is, once you research, then you go and you talk to mortgage brokers and see what you qualify for. What is the first time home buyer incentives? And you want to make sure that you're asking these people questions that, you feel that you need to ask them, like, how many loans have they approved this year? What are the first time home buyer incentives? How are they with responding back to, people when it comes to, mortgage, all these different type of questions, because you want to make sure that person is right for you. So getting pre-approved now. Do not let people just run first of all, if you know that your credit is not up to par, don't let anybody run your credit. Get your credit repaired. I can help you with that. But don't even if you don't have any problems with credit, or you don't have them run your credit. They're going to try to talk you into, so let's see what you qualify for. No, have all your paperwork in order before you go see a mortgage broker. Have your W-2. If you're a W-2 employee, have your 2 years tax returns, your income statements, which is your pay stubs, have your credit card statements, have any other income that you are receiving, SSI, child support, alimony, if you have investment accounts, have your bank accounts, like have all your paperwork together, and tell them, okay, and have your credit report already printed out, and say, and your credit score, and say, hey, this is what I have, this is what, look through. They should be able to look through that and tell you exactly what you qualify for, because they'll see your credit report, they'll see your credit score, they're looking through your finances. So bring your paperwork to the meeting. It's a meeting, and treat it as such. And don't let them just run your credit. You make them do some work. Okay. So lastly, you want to work with a real estate professional like myself. So, partner with a real estate agent. I know you're probably hearing about NAR and all these different things. It's fear mongering. It's always good to work with an expert who knows the climate, the locale, the market, all of those things, so that you can make better informed decisions, plus the research that you've done on your own. So don't trust anybody's research but your own, but also consult with professionals. But educate yourself first, consult with professionals, and then you can be able to make an informed decision, because that's what you want to do. So working with a real estate expert or professional will give you more knowledge. It can help you be able to move, and navigate through the market, negotiate your offers, and guide you through the complexities of the purchasing process, because it is a process. Okay, there's so many several steps. I'm having a publication that I'm putting out to help people, guide them through that. It's going to show you how to talk to lenders, how to talk to banks, how to, what you need to do as far as your credit lines, all of those different things. So I'm going to be doing that pretty soon. So my time is up, and I want to just, come back and just say, you can make your home ownership dreams a reality by doing just simple steps. Okay. If you're 3 months out, looking at your finances, making sure that you have, looking at your, boosting your credit score by paying off debt, saving for, those different expenses that you're going to need. Because like I said, you have first time home buyer incentives. So you might not have to pay the down payment, all of it, but you still have to pay for inspection, appraisal, and other little things. And you also can take some of those expenses out of your 401k. Now, if you have a 401k, now usually, but you have consult your financial advisor and your employer. You usually can take out a certain amount of money to purchase a home. So you might not even need to, if you're 3 months out and you have a 401k, you have your financials and you know what you want, then you can use your 401k as the money that you need to, purchase your home. And you won't have any penalty. But consult with you. I've done it, so that's how I know. I have other clients who have done it. So but consult with your employer and your financial advisor. Okay, on that. But that's 3 months out. If you 6 months out, you're talking about researching your type of properties and neighborhoods. You want to buy low, and so that you can sell high in a neighborhood that's up and coming, or that has increased potential, appreciation potential. You want to go and talk to a mortgage loan broker by having all of your paperwork instead of them running your credit. Have all your paperwork. If you're a W-2 employee, have your 2 years tax returns, have your pay stubs, have your credit card statements, any other income that you are receiving. You have those statements. And if you are a business owner, be prepared to have to show them 5 years of in your 1099s and your income statements and your balance sheets and asset lists and all of those different things. And then you work with a real estate professional like myself. So if you have any questions, okay, about the home ownership process or financial literacy, I would love to assist. So reach out to me. You can comment on this video. You can put assist. You can comment assist on this video. My link is in my bio on my Instagram. It's also going to be attached to my live on Facebook, and it's in my description for my YouTube. So you can reach out to me. I'm everywhere. You can find me everywhere. Something's wrong with my Snap right now. I can't get in my Snap. But you can't find me on there right now. Well, you can find me, but I can't get access to it for some reason. But I'm on Facebook. I'm on Instagram, LinkedIn. You can find me everywhere, but my link is in my bio, is on this videos as well. So I bid you adieu. Have a blessed day, and I will see you in these social media streets. Bye.